How's it going today, guys? So today we're going to be talking about investment taxes, or the taxes you should expect to pay as an investor. And this is one of the most highly requested videos I have gotten, and I do apologize that it took me so long to actually make this video, but there is a lot that goes into investment taxes, and I wanted to make sure I had all the information ready. That way I could give you guys a really good idea and overview of what types of taxes you will pay as an investor, the difference between short-term capital gains and long-term capital gains, as well as things like deductions that investors can take advantage of that many people are not aware of. Now, this is a very important topic. In fact, I have an entire section of my stock market mastery course dedicated solely to investment taxes. Now, if you guys are interested in the stock market, I would recommend checking out my stock market mastery course. The first 30 days is just $14, and at any point during that time, if it's not what you're looking for, you guys can get a full refund, no questions asked. And that is over 12 hours of content, just like this video here. But anyways, let's get right to it and talk about investment taxes. So first of all, I think we can all agree that it is more important to look at what we actually hold on to versus what we actually earn. And it's interesting because most people have no idea what they're going to pay in taxes when they recognize a capital gain from an investment. And everyone talks about how much money they made off a particular stock, and very few people talk about how much they're actually going to keep after they pay taxes. And the truth is, there's a huge difference in the amount of taxes you're paying when you look at a short-term trader versus a long-term investor. Now, do understand that this is an overview of the taxes you will pay as an investor, but this is not a replacement for a consultation with a tax advisor. I personally have a tax advisor. It is well worth it, and we'll talk about this later, but you can actually deduct the expenses paid with your tax advisor anyway. So I would highly recommend having a tax advisor yourself and asking them these questions, but if you're looking for just the basics, this should be covered in this video here. So the first thing I want to tell you guys is that all investments are not taxed the same way. In fact, our taxation system favors long-term investors over short-term traders because you are going to pay less taxes when you have a long-term investment. A lot of people don't realize this, and a lot of people are on the fence when they're deciding whether or not they want to follow a long-term investing approach versus a short-term trading approach. And myself, I push the long-term investing strategies, and this is just one reason, is because you're going to pay significantly less money in taxes once you recognize a capital gain from that investment. So if you're on the fence about it and you're not sure if you want to be a long-term investor or a short-term investor, I'm hoping that after you understand the tax advantage, you're going to be leaning more towards the side of being a long-term investor. So what it comes down to is this: your investments can be taxed as a short-term capital gain or a long-term capital gain. Any short-term capital gains are going to be taxed as ordinary income. And this is very simple to understand. Most people work a job and you have an idea of what tax bracket you fall into. So any income from a short-term capital gain is going to be taxed at the same rate as the income from your job. Now, what many people don't realize is that long-term capital gains are taxed at a lower tax rate. And that's what we're going to talk about down here. We're going to talk about the tax advantage and the difference in the taxes you will pay based on the bracket you're in. But just understand there's a significant tax advantage to being a long-term investor. So understand that if you are getting taxed at the short-term capital gains tax rate, that is the highest tax rate you will ever pay as an investor. So really, it is in your best interest to lower the amount of money you're going to be paying in taxes, or lower the amount of capital gains that are going to be recognized as short-term capital gains. That is the easiest way you can lower the amount of money you are paying in taxes, is by making sure you have long-term capital gains. The other thing that is taxed as ordinary income is any dividends. And it doesn't matter if it's a cash dividend or a stock dividend, and even if you have a drip and you're reinvesting those dividends, that is still going to be taxed as ordinary income. So if you're somebody who is investing with an income approach and you are investing in dividend stocks and you're getting those dividends every quarter, do understand that at the end of the year, any dividends that were paid to you, you're going to have to pay the same tax rate as you pay right now on your ordinary income. So you either have to sell some of the stocks that you have acquired, or sell a portion of your portfolio, or you're going to have to come up with the money yourself in order to pay for that tax bill. Now, there is a way that you can avoid paying taxes on your dividends, and that is going to be a topic for another video, but that is to invest through a tax-sheltered account. Now that would be like a Roth IRA, for an example, where you have paid taxes on the way in, and then your investment will grow tax-free. So if you're looking to invest and not pay taxes on your dividends, the only way to do that is to invest through a tax-sheltered account like a Roth IRA. Other than that, you're going to have to pay taxes on your dividends, and there's really nothing you can do about it. But as far as the amount of money you are paying on your capital gains, if you hold them for a longer period of time and they fall under the category of a long-term capital gain, you can significantly lower your tax bill. So first of all, let's talk about the short-term capital gains. So what is considered to be a short-term capital gain? This is any time you enter a position and then you sell later on within 12 months. So if an investment is purchased and then sold within 12 months, it's going to be taxed as ordinary income, which is the highest tax rate that you will pay as an investor. Now, if you're wondering what date they actually use, they are using the order execution date, not the settlement date. So if you want to make sure that you have a long-term capital gain, you need to hold the investment for at least 1 year and 1 day. So if you bought a stock and then you sold it on day 365, that would be considered a short-term capital gain. However, if you waited 1 more day and sold 366 days past the order execution date, at that point you would be taxed at a long-term capital gains tax rate. Now again, another way you could avoid paying that short-term capital gains tax is to invest through a tax-sheltered account. But that's going to be a topic for another video. I just want you guys to understand there are ways around paying taxes if you're smart with your money and making the right decisions. So what is considered to be a long-term capital gain? That is any capital gains on an investment that is longer than 12 months as far as how long you've held that investment. So as we said, if you bought a stock and sold it 366 days past the order execution date, that would be a long-term capital gain. And now we're going to talk about the actual tax advantage associated with going long. Okay, so now I want to clear up a few common questions I've gotten in the comments section below, and just questions that people have had about investment taxes themselves, and things you might come across and be curious about yourself. I know this sounds like common sense, but I just want to make this statement. You are only going to recognize a capital gain or a capital loss, which we're going to talk about later, if you sell. So you could be invested in a stock and you're up thousands of dollars, but if you don't sell and close that position, you haven't recognized that capital gain. So understand that you're only going to pay taxes once you sell the investment. As long as you don't sell, you will not pay taxes. You're going to pay taxes down the road. Another question people have is, what information are they using when they're looking at what you're going to be paying in taxes? They're going to look at the record date, which is the date you go on record as being a shareholder, to determine the duration of time as far as how long you've held that investment. And that's the same as the order execution date. And they also are going to look at your cost basis per share, which is the average price you've paid per share. So it's obvious that whatever the difference is between the price you paid per share and what you sold for, that is going to be your capital gain or your capital loss, and that is what you are going to be paying taxes on if that is a capital gain. Another question I have gotten before is about short selling. People are curious whether or not a short position falls under a short-term capital gains tax or a long-term capital gains tax. Any capital gains from a short sale will always fall under the short-term capital gains tax, even if you held that short position for longer than 12 months. That is just how the tax code is written. So if you are short selling or you're considering that strategy, understand that you will always pay the highest tax rate and you're going to be taxed at ordinary income. So what happens if you invest in a stock and you've made a bad investment and you sell down the road for a lesser amount than you paid? Well, at that point, you have recognized a capital loss instead of a capital gain, and you guys are going to want to pay attention to this because you can actually deduct some of your capital losses from your taxable income each year. Now again, I just want to make sure you guys are clear on this. In order to recognize a capital loss, you have to close out your position. So even if you're holding a stock and you're down thousands of dollars, you haven't recognized that loss because you haven't closed that position. But once you sell that stock and you no longer own it and you've recognized that loss, at that point you have a capital loss that you can use to deduct from your taxable income. So a capital loss is tax deductible, and it is also something you can use to offset a capital gain. However, there are limitations to how much you can deduct each year, so make sure you guys are aware of this before you start recognizing capital losses on your investments just to deduct that from your income. But for the average investor out there, if you make a bad decision and you decide to recognize a capital loss, well, this can make that loss a little bit less painful. So currently, you can deduct $3,000 of capital losses from your taxes each year, and that is the maximum. However, if you do have more than $3,000 of capital losses, you can deduct those from your income in tax years going forward. So don't just get excited and start selling your investments that you're down on because of the tax reasons. Understand that you can only deduct $3,000 per year. So if you had $30,000 of capital losses from a really bad investment, you would have to deduct those losses over the course of 10 years. You couldn't deduct them in 1 year because there is a $3,000 cap on the capital losses you can deduct from your income. Now, a lot of people think that there is a tax loophole here when it comes to recognizing a capital loss and being able to deduct that from your income. And unfortunately, the IRS has made it clear that this is not a tax loophole. Couldn't you just sell an investment, recognize a capital loss, and then buy it back? That way you can deduct that amount of money from your income. And you can, as long as you wait a long enough period of time. So our friends at the IRS have written a piece of tax code known as the wash sale rule, which prevents people from buying back an investment they just sold and recognizing a capital loss. So if you sell an investment at a loss and then buy it back within the next 30 days, the capital loss is not valid due to that wash sale rule. So if you do want to take advantage of a capital loss and then buy the same investment back down the road, you have to wait longer than 30 days. Otherwise, that falls under the wash sale rule, and that capital loss cannot be recognized. Anyways, now it is the exciting part. So I want to show you guys the tax advantage associated with going long. So on the left here, we have the tax bracket, and this is going to be whatever tax bracket you're in right now or what percentage taxes you are paying on your ordinary income. Then in the middle here, we have the short-term capital gains tax rate, and it is exactly the same as your ordinary income. So whatever you're paying in taxes, that's what you're going to pay on a short-term capital gain. Over here on the right, we have the long-term capital gains tax rate, which is significantly lower. And then in the green here, the tax advantage associated with going long. So if you are in the two lowest income brackets, if you're taxed at 10 or 15%, your long-term capital gains tax rate is 0%. So you don't pay any taxes on a long-term capital gain versus paying 10 to 15% on a short-term capital gain. Now, if you are taxed anywhere from 25% to 35% on your ordinary income, and this is where most people fall, you're going to pay just 15% on your long-term capital gains. So as far as the actual tax advantage goes, it's a little bit better for people of higher income brackets. If you're taxed at 35%, there's a 20% tax advantage associated with going long. If you are taxed at 33%, there's an 18% advantage. If you're taxed at 28%, there's a 13% advantage. And if you are taxed at 25%, there's a 10% tax advantage associated with going long and holding that investment for longer than 1 year before you recognize that capital gain. And then for the highest income earners out there, the people being taxed at 39.6%, your long-term capital gains will be taxed at just 20%. So they have a tax advantage of 19.6%. So I'm hoping this is going to open your eyes to the reasons why you guys should be long-term investors. It's because the tax system actually favors it. So all the short-term traders out there, all the short sellers, they're paying the maximum amount on their capital gains, while the long-term investors have a significant tax advantage associated with going long. Anyways, guys, we have covered a ton of information in this video, but the last thing I want to talk about are the common tax deductions you can take advantage of as an investor. So at the end of the year, when you are filing your taxes, make sure you keep track of these expenses because you can deduct them from your income. First of all, any investment interest is tax deductible. So if you are short selling or you are buying on margin and you're paying interest on your investments, you can deduct what you are paying in interest. Another tax deductible expense is any record keeping and accounting fees associated with your investments. So if you are paying somebody to keep track of everything for you, you can deduct those expenses. Like I said earlier, guys, I would highly recommend talking to a tax advisor, and your tax preparation fees are tax deductible. Just another reason why it's worthwhile to make sure you're not missing out on things or not realizing you have these deductions available to you. Another common deduction that most people don't know about is you can actually deduct the depreciation of the equipment that you use to manage your investments, as long as it is used solely for your investments for greater than 50% of the time. So if you are managing your investments from a desktop computer and you spend more than 50% of your time on that computer working on things related to your investments, you can actually deduct the depreciation of that piece of equipment from your taxes. Anyone who has a financial advisor, you can deduct your financial advisory fees as well. And if you have to travel any distance to meet with your financial advisor, you can deduct your travel expenses associated with driving to and from meeting with your financial advisor. So if you have to drive across town a couple times a year, maybe keep track of that mileage because it is tax deductible. And then the final tax deduction that most people are not aware of is if you buy a safe or a safety deposit box to store your documents, that is tax deductible. So there are a bunch of tax deductions you guys can take advantage of, and this has been investment taxes in a nutshell. I know we covered a lot of material, and if you guys have any questions about what we talked about, please leave me a comment below and I will be sure to answer all of the comments. But I thank you guys for watching this video. If you enjoyed it, please drop a like. If you are new to my channel, please consider subscribing to be notified of future uploads. And as always, I thank you for taking the time to watch this video.